formed a company, became CEO of the company, and licensed the technology from the university. And very interesting guy, very charming fellow, very believable, very smart. And literally, he was in the university there one day, and somebody was touring one of the senior executives from one of the big companies in town, and the executive met this young guy, and there was this exchange that happened right there in the hallway. Actually, it was outside the Von Liebig Center. And what transpired was that the executive pulled his checkbook out, wrote a check, and essentially set the pre-money value for the next round based on his investment, which was outside of what the angels would invest. So that guy basically killed himself because he was not able to do the next round. And so what we try to do is encourage these early stage companies to think about how much money are you going to need, and what's the next round going to look like versus the current round. Are you going to have to do a down round at the very beginning of the company, which was the case with this guy? So it was really unfortunate.
So on that vein, friends and family can get crushed, and you really don't want to do that to grandma or dad. But that happens when you have a $4 million pre-money from friends and family. So that happens all the time. Regarding non-dilutive stakes, we do deals as long as the non-dilutive stake is from a IP holder. So UNM, up to a certain level, you have to keep the 4.5% ownership to back of the university, and also Atlanta, I think it's 4.5%, up to a certain level of valuation.
Then I think with us on the dilution issue, typically Series A, Series B, we get weighted average anti-dilution. We don't get full ratchet. It's almost impossible to get that. So in the event of a down round, weighted average anti-dilution helps you a little bit. Having gone through this a few too many times after the bubble burst, it doesn't help you that much. Really the only anti-dilution protection that you have is to participate in the next round. And you get right down to it. There was an earlier question on compensation, and usually when a Series A round has been done, I'd say salaries go up because you do have more money now to go run the company, do the sales and marketing. I think we're always sympathetic to the fact that the entrepreneur and the team's been at it for anywhere from 2.5 to 5 years. And they've tended to have credit cards cranked up and everything else. The last thing we want them to be focused on is a bunch of domestic concerns. So our philosophy has been, what I would call kind of market salaries based on benchmarks. There's lots of benchmarks that are out there with a very nice performance component. So if the team, you want the team motivated, and if the team is hitting the milestones, absolutely, 40 to 50% bonuses on base is appropriate. That's our opinion.
We haven't done any deals that I know of with a non-dilutive early investor, but given where we are as the first place to come to, it seems to be a pretty easy negotiation. You want our money, we're going to have to rearrange the cap table so that you have a bunch of equal common shareholders and eliminate the preference.
Yeah, I thought I was being naive, but it was one of them. That was when I said, forget it.